They just released a new report about our GDP and the economy for the United States. Surprisingly, it grew by 2% instead of the 1.3% that was originally reported. It got me thinking about the recession and economic slowdowns that people have been worried about. See, the economy wasn't slowing down as fast as everyone thought, but that doesn't mean we're completely out of the woods just yet. We still need to be cautious about the future. Inflation is a real concern and it's affecting all of us. Prices for many things keep going up and people are struggling to keep up with expenses. Now about interest rates, they've been going up as well, and it might not hit us right away, but there's a delayed effect that we need to be mindful of. Remember how we got into this situation in the first place? And let me refresh your memory. It all started back in 2021 with a significant amount of money printing, and according to the NASDAQ, there was a massive 13 trillion injection of new money into our economy. That's a huge amount of money, and you might think it's a good thing because people suddenly have the ability to spend more. Businesses can hire more people and expand, and individuals can buy and finance more things. But here's the thing. When you pump so much money into the economy like that, it can lead to a problem called inflation. Now, inflation is when the value of the dollar decreases because there's just too much money floating around. And you know what happens when inflation kicks in? The prices of everything start going up like crazy. So everything you want to buy suddenly becomes more expensive. Your everyday stuff, your gadgets, even the things you need for the house. It's like the cost of living shoots up, and that's not good for anyone. Now, the Federal Reserve Bank is now trying to cool down this high inflation because it can really mess up our financial stability. We know they're trying to slow down the rising prices of things by raising interest rates. And it's their way of dealing with all the money that was created back in 2021 and 22. And honestly, I don't think people fully grasp the consequences of all of this money printing. Now, this means it's going to be tough for us as well, and it'll take time and effort, and we might feel some economic pain as they work to remove that excess money from the system. Right now, people could still spend, but it's not as easy as it used to be. Just look at the credit card debt levels. They're hitting new record highs, and people are even dipping into their savings now. See, in our economic system, we operate on a credit-based economy. That means people don't just spend based on their cash that they have. They spend based on the credit that they can get. So let me give you an example to make it easier and clearer. If you have $100 in your bank account and the bank is willing to lend you another $100 through loans and credit cards or debt, you now have $200 worth of spending power. Now, over the last few years, both the spending power and credit worthiness have increased. People had more money due to higher incomes and more jobs, and with low interest rates, credit worthiness soared. Now, this allowed businesses and individuals to spend even more, but there was a catch. Many people today are getting into debt to maintain their lifestyle. It might seem convenient in the short term, but it can lead to trouble in the long run. There's a limit to how much debt a person can handle, especially now that all these interest rates have gone through the roof significantly. So now the Federal Reserve Bank has been sending signals about raising interest rates, and that's not good news for anyone. And it means borrowing money will become more expensive. And let me tell you, I've been through some tough economic times, and rising interest rates combined with increasing debt levels can lead to a real mess. Now, some experts like Deutsche Bank are projecting that around October 2023, we might start feeling these effects of this. The extra money we've been seeing in the economy will likely start disappearing. And when that happens, people and businesses won't be able to spend as freely as before. This tightening of spending can cause economic troubles, and businesses may struggle to handle their higher expenses since inflation has been on the rise. And that means businesses have to pay more in salaries, which adds to their costs. They also need to shell out more in rent and for all of their expenses. But here's the thing, business debt works differently from a regular mortgage. It often has adjustable rates that can change every few months to years. Now, in the next 18 to 24 months, a lot of these business debts are going to reset at higher interest rates. And let me tell you, these interest rates are much higher than what they were back in 2021 and 2022. I, for one, know that rates on lines of credit that I have gone from 4% up to 12%. So they've gone up significantly. Now, as a result, businesses will have to pay much more to service their debt, and at a time where their spending might be declining, this situation could lead to a recession. Now, I want you to understand that recessions are a natural part of our economic system, and they happen from time to time. The real question is, how severe is it going to be? If we still have high inflation when the recession hits, it's going to make things even more challenging. The Federal Reserve Bank will have a tougher time stimulating the economy and helping us get out of the recession. So it's essential to be mindful of these economic factors. So what does this mean for you? Well, it means being financially prepared. Save money, avoid taking on an unnecessary debt, and be cautious about making big financial decisions during uncertain times. Now, if you like this video, check this next video out.